needs. Tonight, we are really thrilled to partner up with SoFi and talk about how to navigate your finances as a nurse. A couple things before we proceed. All good. So for questions, we have two specific spots to stop. And there's a Q&A function at the top right of your screen. That's where I'd love for you to submit your questions. And if you see a question that you also love, go ahead and upvote it so it can be answered appropriately. This is your chance to listen, learn, and connect. If you have any problems with the platform that we're on, there is a question mark at the top right as well that you can log any issues that you have. And then lastly, just get inspired to get your money right with SoFi.
Thank you so much. So assuming that the dog is just very enthusiastic about all of you getting your money right. Thank you so much for having me. Thrilled to be presenting to all of you today. And I am very grateful for your interest, as well as all of the questions that you had provided in advance. So we will leave ample time today for Q&A. But just as a brief introduction, we are going to be covering a few high-level topics today. So first is really just understanding how to navigate inconsistent income, not just as a travel nurse, but as a nurse in general, regardless of the type of employer that you have. You likely have some inconsistencies when it comes to your pay, and that can cause a lot of pains from a financial standpoint. So we're going to cover that. We're going to talk about all the different financial goals that you might have and the best prioritizing those goals to give you a little bit more clarity, so that every time you know, or you get a paycheck or you get some sort of cash influx, you know the best place for your money to go. And then last, we're going to talk about borrowing money. So for those of you who've expressed interest in buying a home or a piece of land, how to get approved for a mortgage, or just generally how to prepare your finances in order to borrow money. And then, as I said, plenty of time for Q&A. As a brief introduction, my name is Lauren Anastasio. I'm a CFP at SoFi. And as we shared with you earlier in the chat, if you join this webinar early, we are expecting our first child in just a few weeks. So a little bit of personal information about me. I have worked at SoFi for about 4 years. I am a certified financial planner, so that means that I spend my days giving advice in regards to all aspects of personal finance to SoFi members. And I'm eager to learn from all of you as much as you're here to learn from me. So again, any tips that you might have for someone who is getting ready to go through labor and delivery in 6 weeks, I'm eager to hear about it. So please feel free to share your tips in the chat, as well as any questions that you might have. Really briefly, do want to acknowledge that there are a bunch of you that have joined us for this webinar today. So although I am a certified financial planner, please don't consider anything that we cover on this webinar as personalized advice. This is designed for the purposes of education. Please always consult individually with a professional before making financial decisions. Okay. So a little background about SoFi. If you haven't heard of the company before, we are a personal finance company. You can find us online, you can find our mobile app, and learn more about the different products and services that we offer. We have been around for a little over 10 years and currently have just over 2 million members. So anyone who's ever taken a product with us is considered to be a member, and one of those member benefits is access to financial planners like myself for one-on-one advice. Any questions that you have about SoFi, I'm more than happy to answer those at the end of our session. So one of the first topics that we wanted to cover, and one of the main pain points that many of you shared in your registration, is sort of understanding how to navigate inconsistent income. One of the common themes I saw when it came to your concerns about your finances was how to transition out of living paycheck to paycheck, or how to times where you may be getting a higher paycheck because you have a that you might go through a drier period of time where your pay is a bit lower or money is less consistent. So unique to nurses and medical professionals alike, There are so many different types of compensation that you can receive. I imagine that much of what you're seeing here probably looks a little familiar. So when you're earning a paycheck or basically earning anything that's outside of a consistent salary that's going to be exactly the same every pay period, whether you're hourly, if you're getting paid shift differential for a period of time, but it's not consistent, if you get overtime, if you have other types of per diem pay or compensation, it does make things so much harder to be predictable. However, there are ways that we can try to smooth that out ourselves over time and make things a little bit easier for you. So some of my top tips for how to navigate those inconsistent paychecks. The first would be focusing on building up cash savings. I know that you've heard of an emergency fund before or a rainy day fund. This is really important, and it's important not just because we might experience a period of unemployment or we might have our car break down or some other type of emergency. It's important for those of us who have inconsistent income to try and kind of smooth that out over time and manage our expenses and the way that we compensate ourselves a little bit more consistently. So one of the values of building up a cash cushion allows you to pay yourself more consistently regardless of what your paycheck looks like. This means that in times of the year where you might be on a contract where you have higher pay, you're still paying yourself the same amount to cover your expenses, to cover your savings, to cover your discretionary desires. And that way, that extra is there for you during the periods of time where those paychecks might be lower. So you're not experiencing as much of a cash flow crunch, you're not accumulating credit card debt, and you're able to live more consistently and more comfortably commit to regular monthly payments on things like a car loan or a mortgage. Second tip in the same vein is to keep a budget to avoid overspending when your paychecks are higher. So I know a budget might seem somewhat elementary. It's one of the first pieces of advice you may receive kind of earlier in managing your own finances. However, it can be really, really helpful regardless of how tenured we are in our career or how experienced we are in managing our money. I try to encourage people to think about a budget more as telling your money where you want it to go rather than a form of like the fun police, right? So a budget isn't supposed to be something that's grown worthy to you. It's not supposed to feel like if you stick to a budget that means you can't have fun because you can't go out or you can't like buy yourself something new. A budget really ensures that you're getting what you want out of your money. So if you know that you want to save, or you know that you want to take a vacation, or you want to buy a new car, having a budget is what's going to ensure that you're able to accomplish those goals. So if you are able to create a budget that's sustainable from one month to the next, that'll help make sure that you're not overspending or overcommitting in months or pay periods where you have a higher paycheck and then leaving yourself feeling frustrated and strapped when those paychecks are lower. Another kind of guideline to budgeting is with the 50-20-30 rule. This is simply a recommendation for how to break down your income into 3 categories. 50% would be for your fixed expenses. So the goal would be that anything that you consistently have as a fixed essential or an obligation, so let's say your rent or insurance or car payment, student loan, etc., you're going to cap all of those expenses ideally at around 50% of your income. If you're able to do that, that leaves you 20% to be able to consistently save, whether that's in a retirement account through a 401k or in an IRA or towards your emergency fund, any form of savings, whether it's investments or cash. And then that's 30% of your income left over for discretionary spending. So that might look a little bit different every month, and that's fine because how we like to spend our money in July might be different than how we spend it in December, but it's still giving us the same consistent amount every paycheck or every month that we get to use at our discretion for the things that we want. So 3 ways we can make that inconsistent income a little bit more smoother, or a little bit smoother. 3 ways that we can try to get out of the process of living paycheck to paycheck, or alleviate ourselves of the frustration of having lower paychecks occasionally. Keep a larger cash cushion, create a budget and stick to it. Try and stick to the 20-30 rule so that you're making sure you're not overcommitting to things like a rent obligation that's higher than what you would comfortably be able to afford, or a car payment that's higher than what you would be able to afford, even during those times where you have lower compensation. Okay. So I'm just going to cover some financial goals and a way to think about prioritizing those, and then we'll stop for some Q&A. Then we'll finish the presentation and do another round of Q&A. So if you have any questions about what I've covered already, or in the next section, please feel free to start getting your questions ready, and we'll cover those in just a minute. So fully acknowledging that we have more than one financial goal at any time. Much of the registration questions that many of you provided had to do with trying to figure out how to do more than one thing at a time. And it's really common to get overwhelmed by all of the financial advice that's out there, whether it's from friends, from coworkers, family members. If you read it on a blog, if you hear it on a podcast, you know that you're supposed to save for retirement. You know that you should pay down debt. You know that you want to save up for a down payment on a home. But how do you do all of those things at the same time? The reality is, while it's very possible to simultaneously work on multiple goals at once, what will ensure that we accomplish our goals as quickly as possible and put us in the strongest financial position is to focus on one thing at a time. So there is an order of priority and a logical order that, from a standpoint, I want to make sure each of you are accomplishing. It's going to put you in the best position where if something happens, you basically have as strong of a foundation as possible so that you feel the least amount of financial impact. So this is sort of the order that we want to take with our financial priorities, and I will go into each one in depth. But basically, we want to start with number 1, which is to build up this cash safety net, move our way from 1 through 8, and only focus on the goal that we're currently on. It's only once we've accomplished goals 1 through 4, for example, that we move on to fully funding an emergency fund. It's really important that we're not skipping ahead. So for example, you don't necessarily want to be aggressively funding your retirement accounts if you have credit card debt. And I'll get into that a little bit more as we talk about each of these. The idea here is what might be most helpful for you from a sanity standpoint, but also a financial standpoint, is to prioritize your goals in a specific order, focusing on accomplishing one thing at a time, getting it accomplished or crossing it off your to-do list as quickly as possible, and then moving on to the next. So for context, I wanted to provide just a little bit of guidance on how to best kind of check each of these off of your to-do list. As far as the safety net is concerned, we want to make sure that before anything else, before investing, before making extra payments on your debt, before trying to save for a down payment on a house or putting money in a 401k, the very first thing that you're doing is building up cash savings. So this is going to be a safety net, the equivalent of 1 month's worth of your essential expenses. So if you add up all of the bills that you have in a given month, so if that's rent or your mortgage, utilities, insurance, groceries, essentially everything that it would cost you to kind of cover your basic needs in 1 month, you want to have that cash equivalent in a savings account before moving on to anything else. Next, if applicable, and you are either on an assignment or you have employment that offers you some type of employer match, this is going to be where your employer is actually contributing to a retirement plan on your behalf, we want to make sure that you're getting that match. So whether they'll match 3% of, or 100% up to 3%, or 50% up to 6%, whatever that percentage happens to be with an employer who would offer this benefit, I would want you to contribute whatever the minimum would be to maximize that free money. We just don't want you leaving money on the table. It's going to be more valuable to you to add to this and get that free money, whether it's 100% return that contribution, than it will be to put it anywhere else. For protecting your income, especially relevant for you in your field, highly important truly for everyone, but especially important for you, even if you have friends or family members who don't value this as highly, because of the likelihood that you might be injured on the job and that your earning is very career specific. You want to make sure that you're protecting your income. So seeking out an appropriate amount of disability and or life insurance is going to be very important to your overall finances. If you're looking for a little bit of guidance as to what would be appropriate, I love Policy Genius. So Policy Genius is sort of the Expedia of insurance. It's one place where you put in your information, and then based on the information you provide, they provide recommendations for different insurance companies that would likely provide you with the best rate or the most suitable policy. Number 4, so you've gotten your safety net built up to the level you need, you're obtaining your employer match, and you have appropriate disability and or life insurance. We want to tackle all of our high interest rate debt. So keep in mind, there are 2 different types of debt. There's good debt and there's bad debt. In this case, we just want to focus on the bad debt or the high interest rate debt. This would be credit cards, personal loans, anything that's unsecured in nature or charging 7% interest or higher. I also put credit card balances that are at a 0% interest rate in this category, simply because in addition to that compounding interest, even if you're temporarily at 0%, balances on revolving debt do tend to wear credit scores down, and that 0% inevitably is temporary. So you want to make sure that you have that paid off before the interest rate skyrockets. So those are goals 1 through 4. Next, we get to our emergency fund. So this is basically revisiting our safety net and building that 1 month's worth of savings up to somewhere between 3 to 6 months worth of your essential expenses. This is going to be hugely advantageous or helpful for you if you ever go through a period of unemployment. A perfect example is the beginning of COVID-19 last spring, when millions of people were furloughed or otherwise let go from their jobs. Having a cash cushion was vital. Even if you had investments, the stock market was down 30%. So you had 30% less money in your investment account one day than you had the day before. This is why having an emergency fund of cash that's not taking any risk is going to be so vital. Once that emergency fund is fully funded, then we can move on to saving more for retirement. We do want to try and do this in tax-advantaged accounts, so not just in a savings account, not even just in a taxable brokerage or investment account, but through an employer-sponsored plan like a 401k or 403b or IRA that you have with the financial institution of your choosing. Once you're at that point where you're saving 15% for retirement consistently, and you've done all of the other stages 1 through 6, then we can move on to our other goals. So this might be going back to school or taking a big vacation, getting married, buying a house. The world is your oyster. This is where you get to decide how you want to spend your money or what you want to save for. And you can save or invest for whatever is important to you. Once you've done that and you truly feel like you're covering all of your bases and everything you could possibly want is being taken care of, only then do we move on to stage 8, which is to pay down your good debt. So this is your low interest, healthy debt, things like mortgages, student loans, car loans, anything that's on an installment and typically charging a low interest rate. we want to make sure that we are allowing ourselves to do all of these other things, to build up an emergency fund, to save for retirement, to buy homes or start our own business, before worrying about being completely debt-free. We don't want having student loan debt or having a mortgage or a car payment to delay those other life events. So I know I've done a lot of talking so far, and we have covered a lot in a very short amount of time. So with that, we will pause and take questions that you've submitted so far.
Thank you so much, Lauren. We have a lot of really good questions. So let's start cracking at it. Penny's asking, I'm new to travel nursing, starting her first assignment on the 14th. Congratulations, Penny. I'm interested in learning how to get a mortgage or a loan in general with inconsistent income.
Yeah, so we're actually going to cover that specifically in the next section. What I would say is, there are a few things that you can be doing in anticipation to keep your finances organized. I promise we're going to cover that specifically. So we're going to flag this, and if we don't cover all of your questions, we'll get to it the next round. That's okay.
Sarah asked, is the 50-20-30 rule for travel contract, or can it be applied to a permanent staff position? Right now, she doesn't see herself being able to do this as a permanent staff.
That makes sense. So I would say you want to try and incorporate it to whatever situation happens to be applicable to you. But I fully recognize and appreciate that keeping that consistency is very difficult when you're either on a contract or if you happen to be in a much higher cost of living area. So for example, it might be far easier for someone to stick to a 50-20-30 allocation of their income if they live in Nebraska, for example, than for someone who lives in the Bay Area or New York or DC. Regardless of how much income you might have, 50% realistically may not be enough to cover housing if you live in Seattle or DC or Boston. So it's a guideline to really set expectations about keeping your fixed expenses or your commitments capped, so that when you are in periods of not necessarily lower income, but just where you might not have higher influx coming in, whether it's because of a contract or because of like W-2 employment, that you're not overcommitted. So if you're trying to set expectations for yourself, it's absolutely fine if your fixed expenses go over 50%, for example, but you do want to adjust your other discretionary spending accordingly. So you may feel right now that you need closer to 60% of your income for your fixed expenses, and that's fine. In that case, you do want to try to cap your discretionary at 20% rather than continue to spend at the same rate. That way you avoid things like accumulating credit card debt. So trying to keep that 50% in the back of your mind as you do things like shop for a car, look for a new apartment, shop around for insurance. Anytime you're committing to something that is going to happen on a consistent basis, just thinking about how it fits in with your kind of more steady income. I hope that helps.
Thank you. All right. Corey asked, are there budget templates, software, apps that you would recommend?
Not necessarily any one in particular that I would endorse, but there are plenty that exist. The reason I say that is just because I'm very old school and I love to. I do try to embrace technology as much as possible. However, I like doing it on my own in a Google Sheet. So I keep track of all of my financial goals and expenses basically in an Excel file. Some people don't want the burden of doing that, and I completely understand. I'm just a nerd. But you can look for some of the more popular apps, or some of the ones I would say I've received the most positive feedback on include Mint. So if you've ever heard of mint.com, or YNAB, YNAB, stands is very user-friendly. SoFi also offers a feature called Relay. Relay is something that's available to anyone who downloads the SoFi mobile app or logs in on the web, and it allows you to do things like sync all of your external accounts so you can see what you spend on your credit card as well as what you put on your debit card. It keeps track of your budget throughout the month, lets you know what percentage of your target you've already spent or you have like left to spend, as well as allow you to track your credit score. So that's a really cool feature that's in there as well. I think you get updates every week. So all of these are free, completely free to use, free to download. It's just a matter of what you prefer in terms of a user experience, but I would recommend, if you're looking for something that's automated, any of those three, Mint, YNAB, or SoFi Relay.
Wonderful. I just shared that in the chat as well, if you wanted to replay that. Great. So Jody asked, should that 3 to 6 months emergency fund be invested somewhere that is easily accessible? If so, where are some good options?
Yeah, so ideally, no. Reason being, we don't want to take any unnecessary risk with an emergency fund. The idea of your 3 to 6 months worth of emergency savings is that not only is it easily accessible, but there's also no risk of loss. And there are really not any investment options where that's going to be relevant. I know that savings accounts are not sexy or exciting right now. Nobody is like over the moon about getting like 0.25% interest. The return of your is so much more important than the return when it comes to your emergency fund. So the goal is absolutely no risk. Every penny is still going to be there for you when you need it. Once you have that balance, though, anything above and beyond, any additional that you have that you're able to save above that amount into investments.
Beautiful. We'll do a couple more. Which retirement savings options would you recommend that they can pursue on their own outside of an employer?
Absolutely. So IRAs, or individual retirement accounts, are probably the most popular and most appropriate. They're very easy to open. Almost any financial institution is going to offer an IRA, and they can be extremely user-friendly. So generally speaking, when it comes to investments, there's 2 different types of investment accounts anyone can have. One is more hands-on. It's like a brokerage account, or at SoFi, we call it like an active investment account. And this is for people who like to pick and choose their own investments and place their own trades. The other is a more managed account, or if you've ever heard the term robo-advisor before, this is basically where you open an account, you decide how aggressive or conservative you want to be, and then you just put in cash and someone else manages it for you. So either of these are available as retirement accounts or an IRA. You just want to make sure that you're choosing a financial institution that you feel comfortable with and that you trust. SoFi offers both those active investment accounts as well as the automated accounts at no fee. So there's no management or advisory fee, no commissions on trades. You really get to pick the type of account that appeals to you. And then you have the ability to set up a recurring deposit, or every time you get paid, decide how much you have available to make a contribution throughout the year. The nice thing about going with an IRA over an employer-sponsored plan is that you can control at any time how much you're putting in, and you also have sort of the liberty to choose the financial institution that you want to work with rather than being stuck with the plan administrator your employer has chosen.
Excellent. We'll do one more and then we'll come back for more questions at our next section. Erin asked, do you see any benefit to paying federal student loans aggressively while they are in forbearance?
I love that someone asked this question. Someone is thinking very strategically. Short answer, no. Reason being, you basically have free money right now. So if your debt is at 0%, very little benefit is going to come from aggressively paying it down. And there are likely other things that I would like to see someone do with their money than aggressively pay down zero interest debt. So for example, if you don't have a fully funded emergency fund, if you have any other high interest rate debt, like credit card balances, if you're not saving aggressively for retirement, or if you have other goals like you want to buy a home or take a big vacation next year or start a family, whatever the case may be, that money is going to be more advantageous to you to set it aside or put it towards those other goals than paying down the balance of what is effectively right now 0% debt. Only if you feel like all of those other bases are covered and you can make a meaningful dent in how quickly you would wind up paying off those loans. So let's say, the loans would be hit off 9 months from now, but instead you might be able to pay them off in 4 or 5 months. Go for it. But if at the end of the day you shave maybe a couple of months off of a 10-year repayment period, go ahead and use that money for something else.
Thank you, Lauren. I'll disappear again and I'll come back at our next question session.
Awesome. Okay. So borrowing money, and this is where we will talk about kind of getting ready for applying for a mortgage as well as any other type of loan. So from a lender's perspective, so for those of you who aren't familiar, again, SoFi is a personal finance company. We started exclusively as a lender. We do offer a variety of services and products today, but coming from a lender's perspective, there are sort of industry standards in regards to what people or underwriters might be looking for, whether you're looking to refinance your student loans, if you're looking for a personal loan, to apply for a car or a mortgage. Many of these are standardized for federal regulatory purposes. So whether it's with SoFi or any other financial institution, you'll likely see some consistencies of what a lender might ask for. The first, regardless of the type of loan that you're looking to borrow or type of debt that you're looking for, your credit is going to be key. So you always want to stay on top of your credit. It doesn't have to be perfect, right? Like there's this myth about having perfect credit or, hitting like an 850, which is typically the highest possible FICO score. In reality, there's very little benefit to trying to have the highest score possible. What you do want to be mindful of, though, is just trying to get your credit score to a place where it's considered to be good or excellent. That's really going to just open up so many more doors for you, especially when it comes to applying for a mortgage. Once you hit a certain credit score, it's usually somewhere around 750 or 760. That's considered to be excellent. Once you hit that excellent threshold, it doesn't really matter anymore. The lender is just going to kind of check a box that you've crossed that hurdle, and everything else in regards to their decision making for your loan will be based on other factors. So if you have a 775, chances are you're already going to qualify for, not only will you qualify for the loan, but you're probably already going to qualify for the best possible rate. Breaking your back to try and boost that score 10 or 15 more points probably isn't going to do very much. But we want to be mindful that we're always making on-time monthly payments. We're using discretion when it comes to opening new accounts and closing accounts on a consistent basis. And we're keeping our utilization rate low. So your utilization rate is the percentage of credit that's available to you that you're effectively using. So for example, if you have a credit card with a $10,000 credit limit and a $6,000 balance, you're using 60% of the credit that's available to you. That would be considered a high utilization rate. Keeping your utilization below 30% is what's going to help keep your score higher. And that's one of the things that we can do, is just be mindful, even if someone has issued us a card with a $10,000 limit, $20,000 limit, doesn't mean that we necessarily want to carry a balance. It's something else. Even if it's a 0% credit card, you might not be accruing interest from one day to the next. Balance on that card is going to weigh your utilization rate down. Besides your credit, they're going to be looking for consistent and predictable income. So please don't be dismayed if you don't have the most consistent paychecks. What they're looking for from a consistency standpoint is your type of employment. So if you have 2 years worth of tax returns where you have income as a nurse, for example, that's going to be most helpful to you. It's okay that your paycheck doesn't look exactly the same every time. Lenders are prepared for this, but they do want to see that you are able to continue to have employment in a similar fashion, that you're not jumping industries on a consistent basis or have significant gaps without employment. The next would be your existing assets. So this is going to be most relevant when it comes to applying for a mortgage, but may also come into play for other things like a personal loan. Having existing assets, that could be a balance in your savings account. It can be accumulated balance in a 401k or other investments. But having either cash or investments, other assets available that might be used for a down payment or for collateral purposes will be really helpful. We do want to be mindful about getting ready to apply for a loan. So someone who had asked a question at the beginning of our question section just a moment ago was saying, like, what can I do to try and get ready to apply for a mortgage? Some of the things we want to avoid, doing anything that's going to impact your credit. So try not to take out any new credit cards. Don't apply for a car right before you want to go through the mortgage process. Don't make huge changes or apply for new credit. So that's the second bullet here. The first one being, we don't want to make big account transfers. So if you have investments that you plan on selling in order to put a down payment on a house, sell the investments far enough in advance that you have the cash proceeds when you apply for the mortgage, and make sure that those cash proceeds stay in the same account. We don't want to be transferring cash back and forth or transferring investments from one account to another where it's going to confuse an underwriter. That kind of activity, as innocent as it might be, can be flags for type of like money laundering activity. So we don't want to cause any flags to be raised or any concern. Keep money where it is and in the form that you plan on having it when you go through the application and the transaction. That'll make the underwriting process easier. And if it is a mortgage on a property, it'll help you close quicker. So the amount of time between when you have an offer accepted on a property and when you can actually go to the closing table and get those keys will be shorter. The other thing is looking for new self-employment. So as a nurse, you may not consider yourself to be self-employed, even if you have 1099 income. We want to try and keep things as consistent as possible leading up to a loan application. Where things get tricky is if you wait until you make a job change and then go and apply for a loan. What's going to happen is your paychecks are going to be different, but especially if you have decided to transition from W-2 employment to 1099 contract employment, it is an industry standard that they're going to look for at least 2 years history of that self-employment income. So even if you wind up making significantly more money as a 1099 contractor, if you know that you're going to make that change, try to apply for a loan before your income changes, because otherwise it might be very difficult to get approved even at a higher income level if you start employment from scratch and you don't have that 2-year history showing that you're able to consistently make that amount of money over a longer period of time. Okay, so We'll answer any additional questions about applying for a loan or what the application process looks like, but did want to kind of summarize everything that we've talked about so far. So as far as our inconsistent income is considered, we want to have an ample cash cushion. So this does mean focusing on building up your cash savings before being more aggressive about saving for retirement or saving for a down payment on a house, whatever else you might be using your money for. The person who asked about making payments on their federal student loans right now, this is a perfect scenario. If you don't have a large cash cushion that you can rely on to smooth out your income over time, use this opportunity, take the money that would be going to those student loans, put it towards that cash cushion instead. You can start making payments again in October or whenever the waiver winds up expiring. Keeping a consistent budget from one month to the next. We know how tempting it is if you have a great contract or if there's just a period of time where you're working night shift or a ton of overtime, whatever the case may be, and you have some high paychecks, for a few pay periods in a row. It's so tempting to use that extra money and like treat yourself or buy something that you wouldn't have bought any other month. We want to try to avoid that, use that extra money, set it aside in that cash cushion so that when we have lower paychecks, we can supplement it ourselves. And then trying to stick to that 50-20-30 rule when it's realistic and possible for you. Again, the basic idea here is to avoid overcommitting to our essential expenses, to our rent payments, our mortgage payments, our car payments, etc., so that we do on a regular basis moving forward, whatever percentage we can afford, are still able to both save and have discretionary spending, and we're not sacrificing our lifestyle. As far as our financial priorities are concerned, so remember, there are a lot of different priorities we could have. Many of us have more than one, but if we focus on one at a time, it does make things far more clear of how we should be spending our energy. We also want to make sure that we're going in a correct chronological order. So cash cushion first, eliminating our high interest rate debt before things like saving for retirement or a down payment on a home, and then allowing ourselves to save and invest and enjoy compound growth before worrying about paying our low interest debts like student loans, car loans, mortgages, etc. As far as borrowing money is concerned, making sure your credit is in good order is absolutely priority one. You could get a new job that pays you twice as much money as what you're making today, get an inheritance from a grandparent or something of hundreds of thousands of dollars and still be declined for a loan if your credit isn't in good shape. So making sure that you're staying on top of your credit is something that we're always able to do regardless of how much our paycheck might be in a certain month. Trying to keep ourselves as organized as possible. So making sure money is in the accounts that we plan on using and we're not moving things around, making sure that you have copies of your last 2 years' tax returns ready to go, ideally in electronic form will be really helpful. And just if you do have unusual activity, so if you did have a year with particularly low or high income, or let's say you had some sort of life event, whether it was an inheritance or you got married and had a ton of cash come into your account because of like monetary gifts, you just want to be prepared to have that conversation with a lender. You want to be able to explain what these large inflows or outflows may have been. So with that, we will do our best to take the rest of your questions. I think Nicole is still here. Let's see.
There we go. Little delay. All right. Yes, we have lots of great questions. Let's deal with the ones that are upvoted. So Sarah asked, with some of these high paying assignments, she's concerned that she won't be taxed appropriately and end up owing at tax time.
Mm-hmm.
He knows you're not a tax professional, but have you heard anything about travel nurses and taxes this year, or any type of those professions where they saw quite a bit more income? Do you know anything about them owing money or audits, anything of that nature?
It's very difficult to anticipate for next tax filing season. People are still kind of navigating the quirkiness that was filing for 2020. So personally, like my sister-in-law just got a notice the other day that her refund is delayed like another 60 days because they just need more time to review her return. It's not that anything was wrong with it. It's not like she's not going to get her money. It's just that the IRS is so unbelievably overwhelmed right now. If there was ever a group of people that were like unbelievably in the weeds, it's it's the IRS. So it's very difficult to predict really far in advance. But one thing that I do recommend is thinking about incorporating a tax professional in your personal network. So I know that the idea of hiring an accountant seems like an expensive luxury. However, realistically, finding an accountant who might help you prepare your tax return, they might charge you $250 to file your return, and you don't have to hire them to do that. You can still have an accountant or tax attorney or CPA, other enrolled agent, just be there for questions and has a resource for you without paying them to file your taxes. In the grand scheme of things, I don't know, I challenge you to think about how easily you might spend $250 on dinners out. It's usually pretty worthwhile to not consider it a luxury, and I suppose find other things that you can easily cut out of your budget in order to have this professional. The reason an accountant is so helpful isn't because they file your return, it's because they can give you really, really good advice throughout the year. Things like, should I be putting money in a SEP IRA, in my traditional IRA, in a Roth IRA? Should I do a combination of those things? Should I be using this FSA at work or not? Like other kind of like tactical things you can do along the way. One of those might be making quarterly estimated payments during the year. So if you are a travel nurse and you have really like robust or like busy schedule the first half of the year because we were still going through COVID. Things were absolutely crazy. There was a ton of overtime available. People were swamped. There were other incentives around what would happen to be going on, what the demands look like. And then you expect that things are going to kind of taper off. You may find yourself in a position where your front end of the year was had higher earnings in the back end, in which case you may be better off filing quarterly estimated taxes than waiting until you file next April. Because not only will you not have to pay a large bill all at once, but if you underpay throughout the year, even if taxes are in fact being withheld from your paycheck, if your employer is under withholding, you can still be penalized. So you're going to mitigate the possibility of that happening, as well as alleviate the pressure of one large tax bill for the whole year by looking into the option of filing quarterly estimated taxes. So that's just one method that you can potentially use to avoid that situation, even if we don't know in advance that there might be some like quirky things unique to nurses that would come and kind of bite you in the butt next year.
Great advice. Brianna asked, what do you consider aggressive with contributing to a 401k with being debt-free?
So as a baseline, we love to see people save as close to 15% of their gross annual income as possible. So I would say 15% would be your target, and that can be inclusive of any employer match. So let's say if you put in 3%, your employer is willing to match 3%. Technically, you're already at 6%. If you wanted to get to 15% in that scenario, you would need to save 12, the other 3. However, no such thing as saving too much for retirement. So if you're 15% yourself or more, fantastic. Never in the history of my career, after like 15 years of working with people, has anyone ever said to me, man, I saved way too much money for retirement, because it's just not possible. It does give you significantly more options when the time comes. Aggressive, I think 15 to 20% is more than sufficient. But if you have desires to do something like retire early, maybe you decide that you don't want to work a day past 55, then 20 to 25% is going to ensure that you're able to do that. If you're telling me that you're putting in 30, 40% of your income and you love what you do and you plan to do it up until you have to retire, chances are you can be using that money for other things. So that would be aggressive. If it's 20% or less, then your goal is going to be to work up to that stage. But I wouldn't worry about overfunding your retirement unless you feel it's happening at the detriment of your lifestyle.
This is a common question that we hear from travelers. Penny was asking, when applying for a loan, would it matter if you had worked for 2 to 3 different travel companies instead of just one company?
Great question. It shouldn't. So as long as you, again, like you have relatively consistent income in a similar field. So if you're doing similar work, even if it's different contracts or different companies that you're contracting through, that's fine. You just want to make sure that you have that history. Honestly, for the most part, it's showing up on your tax return. That's what's going to be most relevant. So from like just a administrative standpoint, the documents that a lender is going to ask for in most cases will be your last 2 years tax returns. So in this case, if you were going to apply for a mortgage today, they'd want to see what you filed for the tax year of 2020 and what you filed for the tax year of 2019. So in reality, it doesn't actually go back a full 2 years, but it's 2 years worth of returns. And then your most recent pay stubs. So as long as your pay stubs are somewhat consistent or trending upwards with what your tax returns say you make annually, you're in good shape. And they really, if you change jobs or employers, like you went from one organization to another or used 7 different companies during that time, that's okay.
Let's see, we can probably do a few more. Rihanna asked, besides consistent payment, how else can someone build their credit?
Yeah, so there are a variety of ways that you can look into it. The first place I would start is looking at your credit history now. There are a lot of tools out there. So Credit Karma is a good one. CreditWise is also like a third party that I think is sponsored by one of the credit bureaus. If you have an account with either like Citi or Capital One, there's like a checking account or a credit card, you probably have access to this tool. You can also use, again, through SoFi Relay, the credit monitoring tool. Many of them will give you recommendations on the areas of your credit score that can use the most help. So there is comprised of like 5 different areas. It's your credit history. So those on-time payments, how many total accounts you've had, how many inquiries you've had over the last 2 years, new accounts that you've opened, and your utilization rate. So those 5 things, and they're all weighted differently. So for one person, it might be a matter of everything looks good, but their utilization rate's really high. So for that consumer, the best way to bump their credit score is to pay down some of their balances or ask their lenders to increase their credit line. So for example, if you have a $5,000 balance on a credit card and a $10,000 credit limit, your utilization rate on that card is 50%. If you've had the card for a long time and you have the income to warrant it, one of the ways you can lower your utilization rate without magically coming up with the money to pay off the balance is to call the credit card company and say, I want to remain in good standing with you. I've had this card for a long time. would you entertain increasing my limit? And they might do that. And then when they do that, they often do that without an inquiry, without checking your credit. They'll make that determination based on your income and your account history. So if they bump your limit from 10 grand to 15 and you still have that same $5,000 balance, all of a sudden your utilization rate dropped from 50% down to 30%. So those are kind of the two ways that you can improve your utilization rate if that's what is weighing your score down. For some people, it might just be a lack of history. So if you're younger or only recently started building credit, one very effective way to increase your history is to see if you have like a friend or family member who'd be willing to add you as an authorized user on a card that they've had for a long time. So this is actually a great strategy for teenagers, college students, people in their early 20s who just haven't had the opportunity to build credit. If a parent, grandparent, significant other has had a card for 10 years or longer, they can add you as an authorized user. They don't have to give you access to the account. If a card is issued, they don't have to give it to you. They don't even need to tell you which bank the account is with. But by simply adding your name to the card and having that reported to the credit bureau, you're automatically going to start getting credit on your history for the amount of time that the account has been open. So there are times where I've seen someone who is just younger or rebuilding credit, their credit score jump 100 points after 60 days because they went from having a student loan and a credit card that had been open for 3 months to all of a sudden having an account that had a 10-year history on it. So that is an option that may or may not be available to you, but definitely one to look into. The first thing to do is figure out what area of your score calculation needs the most help, and then figuring out from there how to improve that criteria.
That's very new to me too. That's awesome. We'll do one last question. And this is a kind of a loaded question, so we don't have to spend all day on it, but I think it is important. Tracy's saying that she's an older nurse interested in traveling. What do you recommend for health insurance and disability insurance?
Yeah, so if there are probably providers that I'm not personally aware of. One of the resources that I highly recommend asking would be any HR or benefits contact that's available to you through your contracting organization. So there are probably third parties that would handle this. I don't know the names of them personally, but I would start there for references. Again, Policy Genius is sort of like a catch-all for any type of insurance that you might be looking for. And the reason that I love them is because they really do it right. Like, they don't share your information. They're not collecting data from you and then just like sending it out to 20 different insurance companies. It really is using one third party to point you in the right direction. So see if there is a trusted contact through your organization that can make a recommendation to a third party. If you can't find anyone, start with Policy Genius, and they would likely be able to recommend a few different insurance companies that would offer you a decent bundle if you got more than one type of insurance through them.
Great advice. Lauren, you've been a treasure trove of information. This has been so great. I've learned quite a bit as well. And to everybody who joined us tonight, I'm sorry we can't get to all the questions. You can always reach out to Lauren as well. As she said, she's a certified financial planner and she's brilliant. And we are going to wrap up the event tonight. I will share the recording in the next couple days and the event wrap up and all the slides. And we also have a very special partnership with SoFi, and there are some discounts on some products that you should absolutely look into to save some money. We will share that out in the email as well. And one last thing, we have lots of events coming up, and the only way we can continue to get better is with your feedback. So you'll get a survey in the next 20 minutes or so. Please share your feedback. This really does help us get better and get you what you need. Lauren, anything else to impart before we go?
No, I was just going to say, I'm sorry that we didn't get to everything, but there will be more information about how to follow up in that follow-up email. So definitely keep an eye.
Yes.
And thanks for all of the engagement. This was really enjoyable.
Thank you all so much for joining us. Have a wonderful day. We'll see you soon.